This is Taking Stock on Bloomberg. I'm Pimm Fox. Now, a shocking pullback in U.S. equities today as U.S. stocks plunged the most in a year. So is this a buying opportunity you should be looking for, or do you head for the exits? Let's find out more from an expert. We've got Conrad Herrmann. He joins me. He manages about $3 billion as portfolio manager at Franklin Resources. And over the last 5 years, his fund has outperformed its peers and the S&P 500. Conrad, good to have you with us on Bloomberg.
Oh, thanks for having me, Tim.
Is today a real opportunity, or does it signal some real trouble for the global economy?
I think one of the things I've learned in investing is just to have patience. When you think about what's been going on, there's a lot of uncertainty, and we saw a lot of panic selling today, and so it could follow through. But
were you one of the panic sellers?
No, I was not.
Were you one of the buyers?
It would have been a good day to buy. I've been traveling on the East Coast, but we may have had some open orders that were picking away with things on the desk.
Tell me about how you're connected to the global economy and the recovery in some of the stocks that you have in the fund.
Well, that's an interesting point, Pimm, because I think what you really have to look at is how the U.S. is recovering. And we've gone through the first year of recovery, and so now we're moving into expansion phase. And I think, in terms of recovery rates, generally the economy does grow at about 4%, whether it's a sharp recovery or whether it's a slower recovery. Generally, the second year of expansion is about a 4% GDP growth. And that drives corporate profitability, which, it gives a lot of flexibility to firms. And there are many differentiations going on around the globe. So you have all the issues that are happening in Europe, but meanwhile in Asia there's a lot of fast-growing economies, and so they're having to temper some of the economic growth. China's trying to tap on the brakes a little bit with their housing market. Australia is raising rates. So there are ways to get levered towards some other areas of the globe.
Talk about this whole idea of a GDP, around, as you said, around 4%, at least in the United States. That's sort of where it would be normal. Is that predicated on the absence of inflation? I mean, if you don't have any inflation, does that make stocks look attractive?
I think stocks are very attractive if you look at them on a long-term basis, and that's the way we go about investing. We try to focus in on high-quality growth companies that are trading at good valuation levels, where the share price doesn't reflect the growth and quality elements of the business.
Tell me about the transport sector and the global economy, because I know that FedEx and Expeditors worldwide, those are two names in the fund. Is that a bet on global recovery? Is there still room for both of those stocks?
I think there's plenty of room for both of those stocks. I think, that we talked before about Expeditors. We've owned that in our portfolio for years, and that's a great example of how you can buy and hold. You can make portfolio adjustments along the way, but that's a company that continues to grow, leverage to the global recovery, and certainly with all the business in Asia. FedEx, they continue to take market share from UPS in their ground business, and they're also involved in the LTL business, where they're also taking share. Less than truckload business, where they're taking share from YRC and all the problems that you've had there. So it's been a lousy market, but we see them. They've taken out $3 billion worth of costs in their structure, and that provides tremendous leverage to the bottom line.
How important is it for the balance sheet of the companies that you invest in? Do you want to see pristine balance sheets?
We generally do look for high-quality balance sheets too. I mean, that's part of the quality assessment, not only the strength and durability of the business model, the strength of the balance sheet, but also the strength of the management team itself.
How difficult is it to get the retail investor excited about buying stocks these days?
It's very difficult, I will tell you. So I think that they have been shocked by two dramatic bear markets over the last decade. When you look at the S&P 500, it's trading in negative territory over the last 10 years. So it's really hard to get them really focusing on equities, where we think the opportunity is.